Hello students, welcome. This is Dr. Chetna Kumawat. We are understanding capital structure theories. In a previous lecture, we have studied net income theory and net operating income theory propounded by David Tarrant. In today's lecture, we will understand some more theories. Traditional theory. This approach is intermediary to net income approach and net operating income approach, and hence it is also known as intermediate approach propounded by Ezra Solomon. That is a cheap source of raising funds as compared to equity capital. Therefore, according to this approach, a firm can reduce the overall cost of capital or increase the total value of the firm by increasing the debt proportion in its capital structure to a certain limit. Beyond this limit, the additional doses of debt may result in a decrease in the total value of the firm because the cost of equity capital will increase due to financial risk. Hence, through judicious mix of debt and equity, the overall cost of capital can be minimized and the total value of the firm maximized. In this way, this approach recognizes the existence of an optimum capital structure. Ezra Solomon has explained the effects of changes in capital structure on the overall cost of capital KO and the value of the firm V in the following stages. First stage. In this stage, the use of debt in capital structure increases the value of the firm and decreases the overall cost of capital. It is because the cost of equity remains constant or rises slightly with debt, but it does not rise fast enough to offset the advantages of low cost debt. On the other hand, the cost of debt remains constant or rises very negligibly because market views the use of debt within reasonable limits. Second stage. Beyond a particular limit of debt in the capital structure, the additions of debt capital will have insignificant or negligible effect on the value of the firm and the overall cost of capital. It is because the increase in cost of equity capital due to increase in financial risk offsets the advantage of using low cost of debt. Therefore, during this stage, there is a range in which the value of the firm will be maximum and the overall cost of capital will be minimum. Third stage, from the shareholder's point of view, further increase of debt in the capital structure beyond the acceptable limit increases the financial risk. This increases cost of equity capital that cannot be set off by the advantage of low cost debt. Hence, the total value of the firm will decrease and the overall cost of capital will increase. Thus, there is a level of using the debt in the capital structure in any firm up to which it favorably affects the total value of the firm, but thereafter, if the amount of debt is increased further, then the effect may be adverse and the value of the firm may decrease. There may be a range which separates favorable and unfavorable use of debt, that is financial leverage. The next theory is theory. Modi-Gilani and Miller theory. Franco-Modi-Gilani and Merton Miller, generally referred to as both Nobel Prize winners in financial economics have propounded the capital structure theory. The Modi-Gilani-Miller theory is identical with net operating income theory in the absence of corporate taxes and net income theory when corporate taxes exist. In the absence of corporate taxes. According to this approach, the market value of the firm and its overall cost of capital are independent of its capital structure. In other words, the debt equity mix of the firm is irrelevant in determining the total value of the firm. The reason is that though the debt is cheaper to equity, with increased use of debt as a source of finance, the cost of equity increases and the advantage of low cost debt is offset equally by the increased cost of equity. Thus, the inclusion of debt in the capital structure affects the cost of equity, but the overall cost of capital remains the same. This theory stresses the fact that a firm's operating income is a determining factor of its total value. This theory also emphasizes the fact that beyond a certain limit of debt, the cost of debt increases due to increased financial risk, but the cost of equity falls again, thus balancing the two costs. In the opinion of Modi, Gilani and Miller, two identical firms in all respects except their capital structure cannot have different market value or cost of capital due to arbitrage process. Arbitrage process is the process of selling a security in a market of higher value by purchasing it in a market of lower value. The approach is based on the following assumptions. Number 1, perfect capital market. Investors are free to buy or sell securities. They are rational and very information is available to them. Number 2, no transaction cost. No cost like commission, brokerage is involved in purchase or sale of securities. Number 3, homogeneous risk class. The expected earnings of all the firms have identical risk characteristics. The firm within a class have the same degree of risk. Number 4, risk. The risk in terms of expected earnings should also be identical for determination of market value of shares. Number 5, cent per cent distribution. All the earnings shall be distributed to the shareholders, that is, there will be no retained earnings. And lastly, no corporate taxes. Initially, have assumed that no corporate tax is paid, but later on in 1969 they removed this assumption. When corporate taxes exists. Original argument that the value of the firm and overall cost of capital remain constant with the increase of debt in capital structure does not hold good when corporate taxes, which is a reality, are assumed to exist. Revised their original stand in their article in 1963. They recognized that the value of the firm will increase and cost of capital will decrease with the increase of debt in capital structure. They accepted that the value of levered firm will be greater than the value of unlevered firm, which can be computed as under value of unlevered firm is equals to earnings after tax but before interest divided by KE, and total value of firm is value of unlevered firm and amount of debt, EBIT 1 minus T divided by KE plus DT. Here V1 is value of levered firm, VU is value of unlevered firm, D is amount of debt, and T stands for tax rate. Let's evaluate this theory. According to approach, the value of the firm will be high due to excess debt equity rate in the capitalization, whereas overall cost of capital will be lower due to excess leverage. But the assumptions on which this theory is based are not realistic, such as perfect capital markets are not in existence, transaction costs do exist, no company pays a cent per cent dividend, and so on. That is why the theory is bitterly criticized. Now let's take a look on modern theories of capital structure. In recent years, the following two theories or approaches of capital structure have emerged. Number one, information asymmetry and signaling theory, and number two, peaking order theory. First, we will have a look on information asymmetry and signaling theory. This theory is in contrast to Modigliani-Miller theory, which assumed that information is symmetrical. In other words, that all investors have access to the same information and share the same expectations about a firm's future as its managers. But in reality, the managers possesses intimate inside knowledge about a firm's operation. As insiders, they will have more information about a firm than its shareholders. They can share this information with shareholders and traders or withhold it if they believe that it is in their best interest to do so. This unequal access to and distribution of information between managers and owners are known as information asymmetry. The information asymmetry and signaling theory, as propounded by Rost in 1977, explains the capitalist structure in terms of the ways in which managers use issues of debt and equity to signal information about a firm's future prospects to less informed owners and investors. For example, by issuing debt, the company would be signaling to investors and present shareholders that the future outlook for the company is bright. Thus, using debt would be interpreted as positive signal about the company's future. On the contrary, the decision by a matured, well-established company to issue equity shares would generally be interpreted by shareholders and investors as a negative signal, indicating that the company's future prospects are not good and that its equity share is presently overvalued. Signaling theory argues that shareholders and the investing public understand these issues, that managers have more information about a firm's future prospects and use financing policy to signal this information to shareholders and investors. So this is information asymmetry and signaling theory. Now the next one is the peaking order theory. The peaking order theory of capital structure was proposed in 1984 by Stuart Myers. According to this theory, the management of firms will follow a different order in their preference for using sources of finance for investment and therefore do not like to maintain an optimum capital structure. According to Myers, managers will prefer first of all to use retained earnings for financing investment rather than to issue debt or equity. If retained earnings are insufficient to fund investment projects and additional financing is required to be raised externally, then managers will prefer to use debt rather than equity. Thus, in Myers' view, a firm's capital structure at any point in time is simply a reflection of its past peaking order preference for long-term financing. So this was it in this chapter. Thank you so much for your patience in learning.